whether it's their investing and their financial planning or their taxes, anytime somebody wants to be smarter or better or know more, please call.
Yeah, you have to be willing to ask the question.
Yeah, you're exactly the people we like to work with.
Right. All right, Bob, it is tax season. So let's talk about how taxes and retirement come together.
Yeah. Nobody likes tax season, but it is a necessity, and it happens once a year. I guess I would summarize this conversation by saying all of our clients have basically one common thought process, which is I'll pay my taxes, but not a penny more.
Sure.
Right?
Yeah.
And so I'm thrilled that we now have a Stonehouse tax office and filled with great professionals that are helping us on that end now. And we're trying to get that goal met. So we want to pay what they have to, keep it to a minimum. And there's so many things we can do year in and year out typically that really help minimize those things. So hopefully we'll talk about that.
Yeah. And taxes can kind of be stressful, right? And I imagine even more so when you don't have that typical stable income coming in from a job, you're relying on your retirement income plan.
Yep.
Which is good.
Yeah.
But it's different. It's a different world when you're in retirement and paying taxes.
Sure.
Kind of stressful.
Yeah, absolutely. A lot of things shift when you go from getting your steady paycheck. The same stuff comes out of your paycheck every 2 weeks or however often you get paid. And then all of a sudden it's like, all right, where am I pulling my income from? So that's where our income planning comes in place. And we talk about pull from here and pull from here. Don't pull from here yet. It just depends on the year. And it depends on the tax laws at any given year. So one of the big things we've just had this year is we're in January of 2023 is the Secure 2.0 Act, right? And yet another fun twist that the government throws at us to move some things and to adapt. So a couple of things really quick on that. RMDs, required minimum distributions, was a big change. Most people, I speak about this because this is money in retirement. So most people used to be at 70.5 for a long, long time. Early on in my career, it was all about at 70.5. If you're not taking money out of your retirement accounts, the government's going to make you take at least a required minimum amount, RMDs, required minimum distribution. Take that out so that we can tax you on it. They want their tax money, right? So people had to do that at age 70.5. Then they bumped it just a while back, a number of years ago, to 72. They bumped it up. You don't have to take it out till 72. And then during COVID, they made some exceptions, and it was even nicer. Now they just bumped it to 75.
Okay.
Which seems cool.
Yeah, that kind of sounds like a positive thing.
It is a positive thing. It's all in your perspective. So not going conspiracy theory at all, but we, as planners, we are always trying to think big picture. And so this will depend, your perspective, I like to use that word, right? We like that here in this office.
New favorite.
Your perspective matters here. So if you're someone who has other sources, you don't really need to tap into your retirement accounts as much. You want to postpone that retirement distribution as long as you can. The downside to that is when you pass away, it goes to your children typically eventually. That used to, years ago, they used to allow what was called the stretch IRA. So your kids can now inherit that. And instead of having to take all that taxable money and pay tax on it, your kids, they had the ability to stretch that over their entire lifetime. Okay. So they could take little chunks of this money out year after year after year. And so it was a huge plus for the kids inheriting that. That was nice, but what they've done also on that side of the deal is they've taken that option away, that stretched lifetime distribution for your kids, and they shrunk that down to 10 years. Oh. Yeah. So if you inherit that money, you could take it all out, from your parents. You could take it all out that year, or you can take 10 years. But at the end of 10 years, it's got to be zeroed out, or you get all kinds of penalties and there's problems. So we want to make sure. So when you look at that big perspective, if instead of just looking at it from the current owner's perspective, or your children or your heirs, what they've done now, the IRS has squished
Yeah.
the window of time from when some people are taking their money out from, they reduced it now 3 years, and it's only 10 years on when it goes to your kids. So they've shrunk that down. So anytime, remember how our system in the U.S., our tax system is it's tax brackets, right? And we all know, because those of us who have been working for years, that as you earn more in any given year, it could bump you up into a higher tax bracket, and even more bumps you up. So if all of a sudden you can only take if you inherit this large IRA and all of a sudden you can only take it out in a certain amount of time, that's going to end up pushing more income, more volume through your tax return in a given year, a higher interest rate or higher tax rate, and that can cause you basically to pay more taxes.
Right.
If you look at the big picture as opposed to any given single year. So not everybody has that problem. Some people are just trying to make their IRAs last. Right. So again, depending on your perspective, that might be a good thing, it might be a bad thing, but ultimately, I'm sure I'm pretty sure the mathematicians at the IRS are saying, we could probably ultimately get more tax revenue doing it this way. So
got it. Yeah.
Anyway, that's
definitely something to be aware of, though, and to plan for.
Yeah.
To work with your accountant, your advisor, to understand, what does this actually mean?
Yep.
It's not going to be the same as it was. So
yeah, it helps. It provides value for what we do because everybody's in a different scenario. So yeah, and it's great to work with an accounting office, right, closely, because we need their help to put those numbers together.
Right.
Yep.
Okay, so outside of the Secure 2.0 Act, do you think most people understand taxes and how they'll be taxed in retirement?
I think most people understand they're going to pay some level of tax. I don't think most people understand all the angles and ways that you get taxed. Okay. So that's usually where we come in to sort of provide some guidance and help show them where to take money from and where not to.
Yeah.
Yeah. Depending on
the magic. That's the power.
So, the biggest thing is you have federal tax and then you have state tax. So a lot of people don't really understand, or maybe they haven't given thought to it yet because they haven't been in retirement. Right. But once they're in retirement, then they'll start paying attention. But states are different, and the Fed's going to tax you no matter where you're living in the U.S. But each state has their own taxation system and rules that we have to play by. So, I think we'll talk about this in a little bit. But there are some states that are more favorable for being retired and living in those states. But everything's a trade-off, Moving, sure. I really don't know anyone who moves to a state because of the tax laws, but it's something that they do factor in before they make that move, hopefully.
Okay, state, federal tax, what other types do we need to know about?
Yeah, okay, so this is where it comes from all angles. So income tax, most people are just familiar with income tax, whatever I have coming in. There's also penalties. Sometimes some of our clients are retiring early, well before 59 and a half. So you have to be careful with that. There's some ways to kind of jump through hoops to avoid the penalties, but there's usually like a 10% penalty if you're taking money out of a retirement account before you're 59 and a half. There are Medicare. I wouldn't say Medicare penalties, but there's something called IRMA, which is income-related monthly adjustment amount. So IRMA is an acronym that stands for that. And what it basically is if you are earning, as you're going into your Medicare year, if you're earning too much money, you're going to pay additional monthly amount for your Medicare premium, which essentially is a penalty. Okay. It's an extra cost, whatever label you want to put on it. So that's not really a tax, but that's something we really do watch out for people. Capital gains is something as well that people don't understand necessarily. If they do move, they sell their house and move somewhere else, there could be a capital gain on that. There's not usually, because the government allows for $250,000 per person. So husband and wife owning a home, selling it, you can have a total of $500,000 of capital gains. At least in Northeast Pennsylvania, not many people are selling their house for more than $500,000 what they bought. But it does happen from time to time, so you do need to be careful about that. But there's other things. So there's a lot of moving parts going on, and we're trying to just minimize everything. Right.
Okay, so that's a lot.
Yes.
How do you coordinate all of that? Do you even try?
Yeah. No, it's super important for us to do that. That's our job. Right. So, we have software that we use. We have analytics that we basically use, and we work closely with the accountants. And I've referenced that it's great to have our accountants close to us and our sister company, if you will. But there's a lot of our clients that have used accountants for years and still use them. So it's not like we do everything in house. It's like everything else. If you're comfortable with it, don't rock the boat. Keep doing that. We'll manage whatever piece of your life you're asking us to. But coordinating all that is really important, because if you really look year in and year out, and then you extend that over 10, 20 years, there's a lot of money that you can save in taxes. And I'd much rather see it in your pocket than in the government's pocket. And that's a whole other story of if you think they spend money better than you. I don't want to go too conspiracy. I already went that way in the beginning. But I think it's important for you to understand that, if you want to save money, and do things smart, we always talk about being smart with your money, then you need to pay attention to these things. And if you're not paying attention, make sure that the professionals that you're outsourcing that to are paying attention, because it does make a difference.
Good point. All right, let's do a little rapid fire just to get an understanding of how different types of income in retirement, because it's not your typical paycheck, right? But you're still having sources of income come in. So let's talk about how those different types of income get taxed. All right. So let's start with 401ks.
Sure. They're the most traditional of the items out there. So 401ks, I have to lump in a whole bunch of other retirement plans, basically employer-sponsored plans, usually when you're at work. So that's 401ks, it'd be 403bs. What else we got there? IRAs that you have. Maybe you set those up on your own, or you have a simple IRA through your job, or a SEP plan, depending on...
So many acronyms.
Yeah, there's a lot of acronyms in our business. Yeah, you're welcome. But those plans I'm talking about are what we would call pre-tax plans, right? You put money in there out of your paycheck every 2 weeks or whatever, and that money went in before tax. So you got a nice tax deduction on it. So that's cool. You're in and you're out. Now you're at retirement. Now it's time to pay the tax on it. So when you retire, let's say you retired with $1 million, you can move that money and you can have that money. You don't owe tax on it at that point. But if you take out $50,000 a year off of that account, that $50,000 is going to be taxed at ordinary income. If you took $100,000 out, you're gonna have to pay tax on $100,000. So all that money you just talked about, 401ks, that's pre-tax. So everything you take out of there is going to be taxable. Right.
You're paying yourself.
You're paying yourself, and you're going to pay the government as you take out of there. So that's one source that it's probably the most common. And I would include pensions in there too. Most people have a pension, or some people have pension plans that sends them a check, but they're going to take tax out of that. Okay.
How about Roth IRAs?
Yeah. So they're kind of the polar opposite almost of that. So Roth IRAs, Roth 401ks now have become very popular. Those are funded with after-tax money. So the money that you took out of your paycheck to fund those over time, or that you sent in at the end of the year to put in your Roth IRA, that money has already been taxed. So if you put $5,000 in there, it didn't change your tax liability that year. So that's funded. What's really nice about the Roth is it grew tax deferred. So as it grew, you did not have to pay tax on that. But the real nice benefit of the Roth is on the back end. So when you're in retirement, if you have Roth 401k or Roth IRA, you can take that money out and it doesn't affect your income tax bracket that year. And that's it's a wonderful F word, flexibility, right? It's wonderful to have that flexibility, because there are some other taxes that we talked about earlier, like capital gains, that if we can keep your income down to certain levels in any given year, and you want to sell a property or sell some stock and there's capital gain in there, we could keep your capital gains down almost to zero, actually zero, if you do it the right way by pulling the right levers at the right time.
Okay, and how about Social Security?
Social Security is... So this is like the un-American thing in my book. I feel like we should. I feel like Social Security should not be taxed, but I mean, you put into it, but that's a whole other story. The reality is, it is taxed, and most people end up paying about 85% of their Social Security. So there are some brackets here that the IRS provides. We'll put that up on the screen here. You can see that if you go to irs.gov, you can pull this up, and you can see that if you're married filing joint, for example, if you're making more than $44,000, all of your 85%, I should say, of your benefits, your Social Security benefits, are going to come into play and be taxable. And of course, they can't just define it simply as saying your income. They have to call it combined income. So you can see here on the screen, if you're wondering what combined income is, your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits, and that equals your combined income. So it's not just a simple thing like, oh, I made this much. Nope. We've got to complicate it. So, I mean, if you don't know how to calculate that, you can talk to your accountant or talk to us. We can at least get a ballpark for it. Your accountant should be able to get it down to the penny. But yeah, in most cases, your Social Security is going to be taxed. At least 85% of it is.
Okay, so we reviewed 401ks, Roth IRAs, and Social Security. There are other sources of income in retirement, though, right?
Yeah. Yeah. It's everybody's personal story, right? So we have, I just talked about capital gains, keeping that down. So anytime you sell a property or a stock, certain things have capital gains attachment to them. Life insurance is one. Life insurance is usually income tax free. So that's a nice thing. But then you have to understand where that's going to fit into your big picture. So that'd be nice. So annuities, it can be really confusing. Annuities inherently are just tremendously confusing vehicles. They do have some pros and they definitely have some cons, but it depends on if that annuity is inside of an IRA or if it's what they call non-qualified. But annuities can be taxed in a lot of different ways. So you just have to be working with somebody that understands that.
Got it.
And that's the key thing. Rental payments is another big thing. Some people have rental properties and will continue to have that in retirement. Other people say, I'm too old to do that anymore. I'm selling them. So, and then they have capital gains. So we have to be careful on all that. Royalties, I've mentioned that before. We have a lot of folks in our market that are receiving gas royalties. They're wonderful when they're there, and then they could go away overnight. So we just need to be really careful on that. But they're taxed in a bit of a different fashion. There's some depletion you can take on that, but it's not your typical tax that you would have with regular ordinary income.
Right. Okay, so can you give me an example of how Stonehouse can help and make a difference with these multiple sources of income coming in at tax time?
Yeah, I can give you a couple examples, right? So the first one would be, I talked about the acronym IRMA when it comes to Medicare. So that extra premium you might get slammed with there can be avoided by using the right combination of income, keeping your taxable income down below certain amounts. So that would be one benefit. And that's over time, that's a big premium that you'd want to avoid, right? So there's one. And also I talk about capital gains. If you, let me throw this up on the screen here. So if you look at the tax rates for capital gains right now, this is for 2023, you can see that if let's look at married filing joint, if you keep your income, your taxable income, basically just below $90,000 at $89,250, you would have zero capital gains tax rates. So we do that. I can tell you right now, we do that a lot with folks with Procter & Gamble stock is a great example. So when they retire, they can keep some of the stock. There's an advanced thing that we do called net unrealized appreciation, where a lot of our clients, to build that flexibility in for them, we have them hold on to a chunk of their stock. And we do that through a way, all through the tax laws that are there. And then they have this ability to sell that stock in future years. And we try, instead of selling it all at once and having a massive capital gain, and making sure that their income levels are within certain ranges. So when they get into sort of a nice sweet spot there, it's a great time to maybe liquidate some of their shares and get 0% tax, capital gains tax, or at least avoid it, or at least keep it in the 15. You don't want to sell stock and take big capital gains tax on years that your income is up high. So that kind of coordination can be, oh gosh, you can save thousands and thousands of dollars if you're paying attention.
Yeah, that's a lot to coordinate.
Yeah, it's fun.
And everyone's different. Everyone's got different sources and everyone's got a different plan.
Yep.
But as you say, nobody wants to pay more than they need to in tax. So we kind of all have the same goal.
Yeah. Well, it's a difference of going, like a lot of folks have walked into their accountant at the end of the year, let's say it's March or April, and their accountant goes, oh, I wish I had known that you had that big stock sale. You're going to get hammered with, tax.
Mm.
You're going to owe $10,000 or something like that. And you're like, oh my gosh, like I didn't know anything
I
about
wish I would have known that too.
I wish I would have known that. So
Yeah.
we try to be proactive, especially when
Yeah.
they make big moves, right? And to say
Right.
like, oh, wow, your royalty income is really high. You're going to be in a different bracket. Let's not sell this year.
Mhm.
Or, way ahead of time. It's just coordinating. It's not rocket science, but you just have to be aware of the law. So
Yeah.
again, back to one of our other videos, that retirement income plan combined with some tax planning, which we do a lot now, and just coordinating all that.
Yeah. And being the person, being the trusted person that client can call when they're getting excited. I'm one of those people, right?
Yeah.
I see an opportunity and I want to jump on it right away. And
Yeah.
to have someone that already knows what's going on in your financial plan, your retirement income plan, and you can easily just call and say, hey, here's what I'm thinking.
Right. That's exactly
Don't tell
right.
me no.
Right.
But no, here's what I'm thinking. And then to be able to not only answer the question of, is this a good idea or not, but is this a good idea or not as it relates to taxes too?
Yeah.
That's a whole other.
And it's all balance, right? You can't. Yeah. I've seen people. I literally have some sob stories of people that held on to stock because there's no way I'm not going to pay that capital gains tax. That's ridiculous. Or they would sell just a little bit, but they would have so much in their portfolio. It's crazy how overweighted. And then, there was definitely a number of people that lost on bank stocks because bank stocks were just, built up. And then to sell it seemed crazy. They've always kind of gone up. And then in 2008, they went down and some of them went away.
Way down. Yeah.
Literally went away, or they got absorbed into a bigger company that bought them pennies on the dollar. And the sad news is, the good news is they didn't have to pay that much in taxes anymore because it wasn't worth it, right? It wasn't worth as much. And so I hate that. So you can't let that tax tail wag the dog or whatever,
Right.
That's a very common phrase, but there's a lot of truth to that. So it's not all investment related. It's not all tax related. It's just got to be balanced.
Right.
Yeah.
Absolutely. Okay. So what my final question is going to be, right?
Oh,
To land this plane, where do I start?
To land this plane.
To land this
Did you use an
plane.
analogy?
I just used an analogy. And it's a pretty good one, right?
It is a good one, yeah.
Where do we start? It is mid-February 2023 when this episode goes live. We're right in the middle of tax season.
Yep.
So can I, as someone who wants to coordinate these things, maybe hasn't had that level of coordination yet, and I can foresee needing that either filing my 2022 taxes or moving forward, can I call? Do I call the Stonehouse tax office? Do I call my advisor? Where do I start?
Any of those options are wide open. So if you call our advisors will first listen to what you're calling and what you're looking for, and then get you started in the right direction. So if it's a tax question or issue right at hand, we'll start there. If you want to start with more planning and then see how the taxes could relate, we'll morph those together. If it's mid-February, late March, and you're calling about last year's returns, it's going to be tight to even There might be a couple little things you can do, but if you're talking about this next year's planning, it's a great time to start. There's a lot we can probably do going throughout the year. Just make sure. Tax planning is about making sure you don't get hit with surprises and that you're paying only what you need to pay. Mm-hmm. Anything extra is that's what you can kick yourself on if you end up paying extra. So I want to avoid those coulda, shoulda, wouldas.
Right. And I've heard Ben Denal say, there's tax filing and there's planning as you go in 1 year, and then there's long-term planning, and there's looking at 5 years out, 10 years out, and it seems like he gets really into that sort of thing. And so it's, we might be here in mid-February 2023, right in the middle of right now tax season.
Right.
With all of our accountants' heads down, really in the books and stuff, right? And so there's kind of levels to this. So it sounds like there's really not a bad time to reach out and start the conversation, because what matters is asking the question, right?
Yeah.
How can I do this better?
So First off, I give Ben Denault. He's our CPA in our Stonehouse tax office. And Ben, to his credit, what really attracted us to want to partner with him is he's, which I think is rare in accountants, he really loves to think real long term. And I think, in fairness to accountants, that most are judged by what's my refund this year.
Sure.
Right. And I don't think that's fair to the accountants, because they're just picking up the pieces at the end. This is what you gave me. Right.
Yeah.
But to be proactive, I think you need that longer look. And Ben has always been focused on, like, okay, well, this year's good, but what about the next 5? And that's pretty rare that I've seen in our industry. So I love working with him on that. So he gets a ton of credit on that. But to answer your question, I think you already said it. There's no bad time.
Right.
And I would say, if anybody out there has questions or is wondering or kind of feeling like, should I call? Anytime, whether it's they're investing in their financial planning or their taxes, anytime somebody wants to be smarter or better or know more, please call.
Yeah, you have to be willing to ask the question.
Yeah, you're exactly the people we like to work with.
Right.
You know, I hate talking to somebody that has no interest in hearing me.
Sure. Yeah, that's no fun.
So if you have, if you want to better yourself, think about the power of time. That's my last comment. I'll let this go. But if you're in your 20s and 30s and you're making some changes now, the results of those changes, it's phenomenal. If you really want to throw some charts and look at that, it's absolutely phenomenal how those little tweaks can really make a difference. If you're in 50s, 60s, 70s, why not make them anyway? They're not going to be as big, but they're still going to be big.
Right.
And so, yeah, there's never a bad time to call.